Welcome to the latest ACCA Advanced Financial Management or the AFM revision course. Now, this is the speedy revision because firstly, I would like to introduce you that there are 12 key areas that we need to focus on in order that we can pass this paper very easily. But as always, before we move any further, I would like to take a look at the past exam paper analysis as well as the exam tips for the upcoming December 25 exam sitting Thursday before we move any further. Now, as always, as you can see, according to the past exam analysis, I divided the areas from the key area number 1 up to the key area number 12. And on page number 6 of our speedy revision notes, you can see the top tips I've given you here. Now, as always, it's just to be the intelligent guess, which means the tips may not be accurate. But I do hope that the tips will work, so that's why I would highly recommend my students to focus on the questions for each tip, including the APV, International Investment Appraisal, the mergers and acquisitions, including the impact on the financial statements where you may be required to calculate some ratios. And also, caring about the interest and forex risks will also be the key. Now, the exam information, as we can see, this exam has 3 questions. I would highly recommend my students to plan the question 1 carefully. And that's why using your first 15 minutes to plan the question 1, to read and plan, read it twice, and that's important. For the rest of 3 hours, I would highly recommend you to take 3 hours over the remaining 80 technical marks. So that's why when you are planning the question later on, how many minutes that we need to spend in each of the question, I would use 2.25 minutes per mark, okay, to do the question paper. So which means that part A of examples that 10 technical marks, so how many minutes are there? So you're simply timing by 2.25, and that being 22 minutes that you need to finish the part A. And of course, from that, you can also calculate the deadline that you need to finish each of the requirements before you actually answer the exam question. So usually that I recommend my students to plan the deadline during the first 15 minutes, okay, when they're planning the question 1. Of course, we know the passing mark will be 50. There are 20 very subjective professional marks there. And I will tell you exactly how to get them step by step when we walk through the exam questions later on. Now, you will be given some formulae, but as far as I'm concerned, some formulae will be very important each and every sitting. So for example, the asset beta formulae, you need to be familiarizing yourself with that, but always assuming the debt beta equals to 0. Don't make any comment on that. And also, you will need to be able to use the interest rate parity theory and also the purchasing power parity theory, okay? Especially that you're testing about the international investment appraisal. For the interest rate parity theory, where you may be required to use that to estimate the forex rate. Okay, so in the hedging question. For the rest of those, I would say that it's fair. So, for example, the dividend growth model is not commonly tested. So, if that's tested, okay, just come back to the formula sheet and take a look at that. And also the M&M per position number 2, not quite commonly tested, but if that's tested, of course, go back to the formula for that, and so on. You're also given the present value table. I don't think that's valuable, but the annuity table is more important. You need to know the annuity. Okay, now the key exam techniques I'd like to share with you is that this paper, approximately 50% will be related to narratives. So that's why if you're given 10 marks narrative, we need to write some narratives. Treat 1 mark equals to 1 sentence. And for each sentence using the conjunction words, for example, because this means that. So usually the 1-line sentence will be absolutely fine. 1.5 line sentence would be better. But if you're writing 2-line sentence, there's no need to do that. So for each point, just leave a space, and that's the best practice. If you're required to estimate something, don't put the narrative in. It's all about the number crunching exercise. Also label your answer. This is the part A, this is the part B. That's important. Don't slot the part B answer into the part A. So in this paper, there are professional marks. For example, there will be 4 communication marks, where you can easily get them by simply telling the examiner, here's the report, subject, what you're trying to talk about, a very simple introduction. Okay, just copy and paste the requirements from the case, and that's fine. And using, for example, 2-line sentences. The content, make sure to answer all the requirements, because if you're not answering all the requirements, perhaps only 3 out of 4 communication marks are awarded. Don't forget, bring the conclusion in so you can earn that professional mark. And for the analysis evaluation marks, so always comment on your calculations first. Okay, so when you finish the calculation in part A, when you come to part B, first is to comment on what you've calculated in part A. If you haven't calculated anything in part A, just to assume a figure in the part B and to comment on that. Because the marking rule has got something called the OFR rule, which means the own figure rule. So this means that you will be punished for the mistake once, but you will not be punished twice. The accurate marks usually from the case information, but we're not particularly sure because each and every time will be different. And the skepticism marks is always about the models, that you would like to challenge the assumptions and the disadvantages of a particular model. And that's all you need to do. So, after we've analysed the exam information and exam technique and the past exam analysis, now let's continue with our revision. Now, the revision itself for this paper, firstly I will go through the key area number 1. It's the basic investment appraisal technique. There are quite a few questions in this area. Before we move on to more of the advanced stuff, which means the APV, adjusted present value. And then the international investment appraisal in the key area 3. Business finance is also important in key area 4. And key area 5 will be the cost of capital. And then how to value a business in the key area 6. And how to reconstruct the business in key areas number 7. And then paying dividend in key area 8. And then the forex and interests in key area 9 and 10. And then some of the narrative stuff in key area number 11. And also the international trade and finance in the last key area. So, as we go through each of the key area, including the examinable areas in there, so we will be practicing a few past exam questions. So make sure that you're absolutely happy with what is going on before we move any further. Okay, that's very, very interesting. Now, let's get started, okay, with our revision. Now, let's see the overview of the key areas. Now, in this paper, I've used a very beautiful chart and telling you what to focus on. Now, what is financial management? Financial management cares about two things. Firstly, managing your cash. Secondly, managing your costs, which means the cost to fund your business. So that's why, firstly, we'll need to look at 3 decisions that financial managers would make. Okay, so usually from the treasury function. For example, you would like to spend your money out into doing something new, that's called investment. Alternatively, you spend your money out in paying your shareholders to compensate for the money that they invested into your business. But you also need to make sure that you've got enough finance in place in order to support the investments you're going to make. So as we can see that these 3 decisions are interlinked with each other. So for example, an increase in finance perhaps will increase the investment and even to increase the dividends they like to pay to your shareholders. Now, not only for that, please do make sure that the cash will really affect the business value. Okay? Because what is the value of that business? The fundamental logic is that, well, we need to see how much cash that you can make in the future. So that's why the business value will include the value of equity and even subtracting the value of debt from the asset. So you can recall what we've learned from the accounting equation, which means the assets equals the liabilities plus equity. Now the equity will be the business value. And of course, we will need to value the asset when we look at the investment. Okay, so we may be told about the future cash flows, including the revenue and cost the business can make and incur. And we'll need to subtract the value of debt in order to arrive at the value of equity. Now, that's important. And of course, another logic behind the business value could be depending on how much profits they can make. Of course, we like to use the PE methods to value that business later on. But in our syllabus, we also need to look at how to value a business when there's a change in risk, especially that we enter into a new industry. Alternatively, we take out additional loan finance. And how we're going to be paying, okay, is the target company. So shall we pay cash, or we owe them money but give them an option to convert that into cash or shares in the future, which means the convertible bond. Alternatively, using no cash at all, we exchange our shares with your shares. So remember, we need to calculate the gains and losses percentage for both parties. So this is a very, very topical area in each of the exam sitting. Now, not just for that, but also when we are looking at 3 decisions, we'd like to move on to the investment appraisal. And that's why the key area in our financial management is all about the NPV, which means the net present value, which means we take into account the future cash flows, which means the relevant cash flows, the number of years in the future, and the appropriate discount rate. Okay, so which means in order to do the project, what will be the expected return from various creditors and shareholders. And we discount the future cash flows into today and to see whether or not that amount is positive or negative. So in simple terms, if NPV is positive from financial point of view, the project can be accepted because shareholders' wealth can be increased or maximized. So do make sure that each and every time put that sentence, the implication, in other words, the shareholders' wealth in your answer, okay, in order to get one technical mark and even one analysis and evaluation mark. So don't forget that when you're undertaking a project, something could change. So for example, if you're undertaking a project overseas, that there might be a change in the foreign exchange rate. So you will need to consider the hedging strategy in place. Alternatively, if you like to do a project, possibly you like to take out some loan, and the interest could change, and that's why you also need to consider the internal as well as the external hedging technique to hedge against the interest rate risk as well. So one of the common example areas would be the collar hedge related to interest rate. And of course, the futures and options. Okay, so these are the external hedging technique that we need to heavily focus on each and every time. We can also see a trend that the swap, okay, way to hedge against the risk could also be tested. So make sure that we also focus on that as well. Okay, now after you look at that, it's important that from the basic MPV, we also need to look at other methods. So for example, number 2, adjusted present value or the APV. Because traditionally, we think the cash flow may include the business risk related to, for example, the product risk and the financial risk. So because we discount the cash flows using WACC, which means the weighted average cost of capital. However, stop a second, think about it. Shouldn't we separate these cash flows into the cash flows that only reflects the business risk and the cash flows relating to the financial risk? So if that's the case, then you're talking about the adjusted present value method. Okay, so later on I will give you the pro forma answers that you can always write in the exam when you're asked about the APV analysis. And of course, if you like to do the project, so for example, overseas, and we are thinking about the international investment appraisal. So don't forget that in the international investment appraisal questions that you may be required to estimate the forecasted exchange rate, okay, using the purchasing power parity theory. And of course, you also need to devise the cash flows that are related to overseas projects, and when you get those cash back into your country where you need to consider additional taxes that you need to pay for. And of course, from the basic investments, it can also be the mixture of topics that you may be examined. So for example, the payback, discounted payback, and duration. So for example, how many years that you can pay your initial investment back by taking into account the time value of money effect, which means the discounted payback. Duration is not to pay your initial investment back. It's just to be a risk measure. And also you need to consider the internal rate of return and the modified internal rate of return. So nowadays we've got the Excel formula to compute that figure directly, so we can ignore the formula given by the examiner. We also need to understand the value at risk, so which means that what will be the chance that the MPV will fall below this level. Okay, the values, the MPV, which means the value that we can get from a project, will be at risk, which means we would like to lose. And also you need to consider the real option as well. So nowadays the real option always use the Excel formula. Okay, so are there any chances that we like to extend that project, delay that project, and so on. So once we've done with that, it's important that we need to consider the risk and uncertainties in this paper. So especially is that the examining team may be asking you, well, are there any factors they need to consider, okay, when conducting such investment appraisal, okay, of a given project? Well, I would say that there might be a chance that something is not true. So for example, we fail to consider the risks, okay, related to it. So for example, we need to consider sensitivity analysis to identify the key variable, probability analysis, for example, considering the percentage chance that something may happen. And if we were to consider the variables interrelationship, okay, that we are considering the simulation. And also we may be adjusting that discount rate as well. All right. That's also important, okay. The higher the rate to reflect, the higher the risk that we like to take, okay, from the project. Now, not just for that, because for the financial management, the key will be to consider the cash flows and its costs. So here we are considering the discount rate as the cost of finance, reflected in the weighted average cost of capital, or WACC for short. And of course, when we are thinking about WACC, the first things that you need to think about will be, where does your money come from, which means your business finance, either coming from debt or equity. And of course, your previous level paper knowledge could be tested. So for example, the pecking order theory, and also the why debt is cheaper than equity. For example, we can get tax saving on interest. So when we compute the cost of capital, for the cost of equity, we've got 3 ways to do that. And for the cost of debt, make sure to identify they need to timing by 1 minus the tax rate, to reflect the fact that because we've got interest expense, this will help us save tax. And also it's the cost of preference shares, okay, before you look at the capital structure. The capital structure, this could be tested as a question that you may be required to calculate some ratio, okay, basing on the different financing options that the company has chosen. Now, of course, linking all of these, we also need to look at the reconstruction and reorganization, because for some businesses, they are public listed companies. However, if the performance is bad, if the performance is poor, the company could be delisted from the stock exchange. And therefore, in order to save that company still being a public listed company, we need to do something there. So for example, if you can't pay off debt, why not conduct the debt for equity swap? We can also restructure the financial statement, and that's why the financial statement's impact could be tested in this paper. Don't forget about the comment side, because we'll need to understand the ratios related to the performance, need to understand the agency stuff and ethics and the ESG. It's a growing trend that this topic is tested. And even the economic environment impact. So for example, the austerity issue happening in one country where everything is so cheap, all right, because the economy is not particularly good. And that's why the government may be doing something there. So what will be the impact on our business later on? And also we need to talk about the roles of different international bodies. So for example, the IMF and World Bank. So these are the areas they need to focus on. Okay, let's get started. Key area number 1. I'd like to revise the basic investment appraisal techniques. So in this key area, there are 6 examinable areas they need to focus on, including something called the free cash flows, and also the mixture of topics such as these. And also you will need to focus on the Greeks and delta hedge. It's quite a small area that the current examining team may not be very interested in, but do make sure that you revise that in case that topic comes up. And also capital rationing, which means we haven't got enough funding in place to do all the project. And how would we deal with it? Now, first things first, let's see the free cash flows. Now, free doesn't mean it's free of charge. is just to be available. Now, cash flows available, which means free cash flow, available to the whole firm. This is what I mean by the free cash flows to the firm. Or cash flows available to the shareholders only, which means the free cash flows to equity. Now, remember, in this paper, free cash flows to equity is also called dividend capacity, which means whether or not you've got stabilities to pay dividend. Paying dividend is all paying cash, and that's why it's just to be the same term. Alternatively, it's also called value of equity. So when you are valuing a business, you can always use free cash flows to equity methodology in this paper. Okay, 9 out of 10. Now, how to calculate the free cash flows to equity? Well, I will say that it's entirely up to you. For example, you can take the operating profit and to subtract any interests, and then, basing on that figure, which means the profit before tax, you then timing by the tax rate, getting rid of the tax, and that will give you the profit figure. But the accounting profit figure, you will need to add back any depreciation, which is non-cash element. You also need to adjust the working capital. So for example, in this case, an increase in inventory will consume us cash because we spend $10 out in buying inventory. And also considering the investment activities, for example, we spend $10 out in buying the land. That's why it's the cash outflow worth of 10. And of course, you also need to consider the debt effect, whether or not you issue additional debt, and also you are repaying debt because that becomes mature. That will give you the free cash flows to equity. Alternatively, you can lay this out, okay, that's what we can see there, because sometimes you may be given free cash flows to the whole firm at the very first start. So if that's the case then, to the whole firm, which means before considering the debt holder and equity holders. And that's why before the free cash flows to the whole firm, we do not consider that interest there. And that's why we need to focus on, okay, the top half of the calculation. But if you ask about the free cash flows to equity in this paper, it's quite often that you will be facing with free cash flows to equity. So you can calculate whatever ways that you want. Okay. If you're not sure whether not to plus depreciation or to minus it, just to try your best. You can put both into your calculation. It's absolutely fine there, because markers will only look for the correct answers and to skip your wrong answer in case the subtotal has marks, but not very likely that the answer can be punished once, not twice. So not a problem for that whatsoever. If you're required to calculate the dividend cover, which means the ability that you can pay dividend, you also need to divide into dividend payment, okay, from the free cash flows to equity. So in this case, 10 times ability so they can pay dividend using your free cash flows, and that's a strong business. Now it's more important now to focus on a few past exam questions, okay, together, so we know what is going on. Alright then, now as always, I would like to use the Excel to do the number crunching, and I'll need to write some narrative later on, okay, using my pen and paper. Right then, okay, let's get started though. Now, in this requirement, it's coming from a past exam, calculates the forecast's dividend capacity. Okay, so we are calculating, for example, free cash flow to equity. And so we are told the operating profit before deducting taxes, 2678, an increase of 3%. Okay, so which means that in 20x5 last year, we take 2678 over 1 plus 3%. And the tax rate 30%, and the debt interests will be 8% there. The debt value 10 to 50. You can calculate that interest on that. And the investment in non-current asset 2430, and also including the calculation of the depreciation. Alright, so which means that we need to plus depreciation worth of 2430, and then we need to subtract that investment in non-current asset. So in essence, it has new and no effect in there. But we've got additional asset investment of 0.25 for every $1 increase in revenue. So that's why we will need to compute the revenue change, okay, which means the revenue for this year and the revenue for last year. So first things first, that we've got something called operating profit at the very first start. Okay. Now, a total about 2678. And then we've got the interests, so subtracting that interest. Now the interest we take 8% timing by 10 to 50. So we take 8% timing by 10 to 50. You don't really have to say quite a lot of things in your calculation, just lay this out in this way. So do the subtotal, and then we sum these two. That will give me that figure. And we need to subtract tax out. So it would be minus this figure, so the profit, will be the tax rate on that, 30% tax rate. So therefore, doing a subtotal again, which means that we are left with 1300.6 profit there. So once we've done with that, we also need to consider the investment. So firstly, the depreciation, okay, we can short for depre, it's absolutely fine there, so the markets can understand that, would be 2430. Just plus that. And also the investment in non-current asset of 2430. So that will have a new effect. And also the additional investments here, in this case, will be $0.25 for every $1 increase in revenue. So that's why I'd like to start working on this. So next to that, we start working. And then what you need to do is to calculate that revenue figure. Because we're told the operating profit margin at the very first start will be 2%. So that's why we need to use sales revenue and to subtract costs, which will give us profit. Because that operating profit margin will be 2%, which means margin is basing on 100% of the sales. And that's why the cost of sales, or the cost there, will be standing for 98% there. And it's because we are told that current year there's 2678. So how about in 20x5, which means last year? As I said, now this year is 2678, because that has incorporated 3% increase in profit. So over 1.03, and that will give me the profit last year of 2,600. So 2,600 standing for 2% of profit, but how about for 100%? So you simply take that 2,600 over that 2%, that will give me this value for the total revenue. But how about this year, 20x6? Well, we're told the profit is 2678. And that's why, to calculate the sales revenue, we take this over 2. And that will give me this one. And that's why the additional investment equals to minus, because for every $1 increase in revenue, we need to spend 0.25 out, so timing by the revenue change. Taking this minus the revenue last year, so that would give me the additional investment, okay, here. So, therefore, we calculate the free cash flows to equity by summing all these down. Alright, that will give me 3 to 5.6. But it's entirely up to you, it's to round them up. It's entirely up to you. Okay, you can round them, yeah, to be 3 to 6. It's entirely up to you. Now, in this question, we are also given the analysis and evaluation mark in your answer. Now, how? Well, if you can attempt this question and doing something correct, so for example, doing tax correct, this correct, or that correct, either one of those, then the marker will give you 1 analysis evaluation mark next to that. Okay, it's quite a fair exam, so don't worry about that. So do attempt all questions. It's time to move on to another question, slightly more complicated. It's called Kodiak Company. Again, it is the free cash flow question here. Now, reading through the requirements. Firstly, you're required to prepare a 3-year cash flow forecasts basing on the free cash flows to equity. Again, okay. And then estimates the value of equity basing on the expected free cash flows to equity and terminal value if the growth rate is 3%. And advise the assumptions and uncertainties. And we are given the professional marks there. I'll show you how in a second. But first things first, let's read through the case. It's a small design company, and therefore in the second paragraph, we'd like to talk about the bank loan, okay, secured against the general asset. There are no outstanding guarantees on the company's debt. Okay, so that's why we may be considering additional finance options. We are given the P&L and the SFP on the left and right hand side, and of course you need to focus on the operating profit. So for example, you need to focus on the interest on loan, okay, as I said before. And on the right hand side, you've got the additions of a non-current asset. So that stands for the additional investment, okay, that made by the company. We also have got the depreciation charge and investment in working capital, and also the operating costs in there, okay, that we'll need to deal with that, all right, in order to arrive at the operating profit. And revenue and variable costs grow at 9%, and fixed costs growing by 6%, and paying interests, okay, does not pay any dividend. So that's why the free cash flows to equity will be standing for the amounts that we owe to our shareholders. And also we've got cash of 50,000 there. So that's why later on when we adjust the working capital stuff, we may be getting rid of the 50,000 because we are assuming the net current assets could be used. Okay, so of course the examiner's report make that clear that you don't really have to subtract that 50,000. You can also get the same mark. And also later on that we'll need to deal with the part B there. Okay, later on. So first things first, let's compute the 3-year free cash flows to equity. Now, I'll highlight in my answer that this relates to part A in the Excel, and then the number of years, the 1, 2, and 3. Of course, when we are required to calculate the free cash flows to equity, we'll always start with the operating profit there. Okay? The operating profit because revenue and variable costs are growing all the time. So that's why we like to start with a working to compute that revenue and also the costs in there. So that's why next to that, I like to start with a few workings. So for example, we've got years, 1, 2, 3 as well. And we've got revenue. Now the revenue was 5,000 there. So that means today is 5,000, but 1 year's time, 5,000 timing by 9% of the growth rate. So 1.09 in other words. So simply copy 1.09 there, and then in year 2, basing on the year 1, timing by 1.09, and then year 3, basing on year 2, timing by 1.09. Okay, so not just for that, but also the costs in there. So for example, the current cost of sales was 3,000. So equals to minus 3,000, and timing by, the cost will also increase by 9% for the variable costs in there. Alright. So 1.09 in other words, and then basing on this figure, timing by 1.09 and timing by 1.09. That will give me the gross profit, or GP for short. So we sum all of these, enter, and then drag it here. Of course, to make it look better, it's entirely up to you. I like to underline it by clicking the U button. Not just for that, because in our P&L we also have got other operating costs. Okay, so we need to compute the operating costs in there. But the operating costs, it's a bit difficult because we are told other operating costs, including the variable as well as the fixed costs in there. So that's why I would like to calculate that as a subtotal value, okay, later on here. So that will include the variable costs in there and fixed costs in there. I like to use the abbreviation FC, it's entirely up to you, it's fine. And also, don't forget, we've got depreciation on non-current asset, so depre as well. Now, for the variable costs, firstly, we've got 750, okay, at the very first start. And it's at 15% of sales, yeah, we are given that. So that's why in year 1, that will be minus 750, and because the variable cost will grow at 9%, so we're timing by 1.09. So basing on this figure and timing by 1.09, basing on year 2's figure, timing by 1.09. How about the fixed costs? We're told about 1,000 there. So 1,000 so equals to minus 1,000. But the fixed costs will grow at 6% per year according to note number 4. So timing by 1.06. So copy that because you know my next step. That equals to this timing by 1.06 and equals to this timing by 1.06. So that will be the sort of stuff. How about depreciation expenses? Well, depreciation expenses a bit difficult. Yeah, a bit difficult. The reason is you will need to understand there will be additions of a non-current asset during the year. And we're told about 66 at the very first start. And also, is it growing? Well, the answer is yes, because if you look at the next page of our note, the increasing the investment by 20% per year. All right. So that's why we talk about depreciation here. Firstly, we'll need to see the non-current asset at costs. Well, this sort of stuff may not form into the actual calculation. So you can label that. It's entirely up to you not to mix them up, okay, with the actual calculation here. Because all you can do later on to put the depreciation expenses here, and that will give you the operating, profit in total, okay? Now, non-current asset costs, firstly, in year one, how much? The total about 1266 at the very first start. So the non-current asset costs, firstly, 1266 at the very first start. But that will change. So for example, it's the additions during the year. But how much? Because now the additions, 66, but will grow at 20%. So that's why we like to take 66 timing by 1 plus 20%, which means 1.2 here. And that will be 79.2. And that being the case, we've got the non-current asset costs in the end. So we underline this, clicking U button, and then summing these down. And that will give me the non-current asset costs, 1345.2. So carry this forward in year 2, why not? Alright, to year 2, why not? So equals to 1345.2. Now the additions will grow by another 20%. So this timing by 1.2. That will give me, just drag it here, that will be 1440.24. So carry this forward, and then equals to this timing by 1.2. So drag it here. So got the revised non-current asset cost there. The next things that we need to do is to base on this figure to calculate the depreciation. Because all we would do is that depreciation, as we can see in the question, depreciation will be charged at 10% per year. And that's why we take 10%, which means minus 10% there, and timing by the non-current asset cost revised. So it will give me, drag it, it will give me the depreciation expenses for each and every year, for example. Alright? Now, once we've done with the depreciation expenses, we can calculate other operating costs there. So you can say to the marker that this will just be a subtotal by using whatever colours that you want. Alternatively, make it italic, but it's entirely up to you. So you simply sum the subtotal of the operating costs there, and you click enter and drag it there. And finally, you can calculate operating profit. So all you can do is to say that, well, operating profit, that we've got gross profit, and then to plus the minus operating costs there, and that will give me the operating profit for each and every year. Okay, so you can use another colour, it's entirely up to you. Okay, so for example, I like to use, for example, another colour, green, why not? It's fine that you use different colours in the exam. Operating profit, okay, at the very first start, we tell the marker that according to working, and then equals to the operating profit there, click enter, and then drag it here. Now, from that, to calculate the free cash flows to equity, you also need to take the interest away. The interest, we're told, is just to be 74 there, because the company pay interest on the outstanding loan is 7.5% per year. That interest rate does not change. So that's why they take minus 74, because all in 1,000, in each and every period. Drag it here. And therefore, you can calculate the profit before tax, PBT. We don't have to say that. It's entirely up to you. So sum them down. Click enter. Drag it here. The next thing, of course, you need to pay tax. Pay tax by how much? Well, tax on profit, 30%. But payable in the following year. It's just to be the tax payment in arrears. So sometimes that could be tested. So that's why I like to use this approach when we are computing free cash flows to equity. So we know that in year 2, that will be minus 30% on the profit in year 1 because we pay tax next year. And then we drag it here. But how about in year 1? Well, that could be the tax payment that we compute in year 0, which means now the tax payment will be $15 here from the P&L. That will be payable in year 1. So that's why I would say that will be minus 15 taken from the P&L currently. Now, after we've done that, of course, that would be the profit that we like. Just do a subtotal, but it's entirely up to you to sum these two. Alright then, now it's time to do other stuff. So for example, are there depreciation expenses? Well, the answer is yes. We've done with that because it's including the operating profit. So that's why we need to plot them back because we cannot minus depreciation in cash. But by how much? Well, as we can see, we just computed depreciation expenses here. You can see my mouse, 134.52, but all in negative. So we would need to put a minus next to that and to click on, okay, that's the depreciation. And we click on enter and drag it here. Okay, that's fine. What else? Well, we'll need to talk about notes number 2, investment in net working capital. As I said, it's just to be a very, very weird working. So that's why we will need to see the WC in the working again, or the working capital if you like. Now, working capital, or WC if you like, it's entirely up to you. Again, we got years 1 to 3, but let me do that again. So 1, 2, and 3. So firstly, let's see the total working capital required. Because the working capital is the relevant net cash flow should be included in our free cash flows to equity calculation later on as the incremental part, which means the changes. We take them into our free cash flows to equity calculation. However, we need to estimate the total working capital that we need, okay, in each and every year. So working capital is just to be the sum of inventories, receivables, and to subtract payables. Okay, it's the monies that we require to put in the operating cycle. So for example, if the working capital is $100, which means we need to figure this out, $100. Where does the $100 come from? So for example, we may be borrowing money from the bank worth of $100 in order that we can put that into the operating cycle. Now, the working capital required, for example, we can see the net current asset worth of $270 in our statement of financial position there. So net current asset simply be the working capital, simply be the current asset and to minus current liability of $270 at the start. But we're also told that we've got $50 cash, which means we do not need to worry about that $50 out from the 270 to borrow money from the bank because we've got that 50. So all we need to worry about will be the remaining 220 of the working capital that we need to borrow that money from the bank. And that's all we could do. So that's why in year naught, that would be 270 minus 50, which means we need 220 now. But how about in year one? Well, we're told in the question that note number 2, the investment in working capital expecting to increase in line with the growth in gross profit, because we just calculated gross profit by considering the 9% of the revenue and the variable cost growth. And that's why the working capital will grow by 9% each and every period. So that being the case, in year one, that we need working capital of 1 plus 9%, which means timing by 1.09. That would be 239.8. How about in year 2? We take the working capital we need and timing by 1.09. How about in year 3? We take the working capital in year 2, timing by 1 plus 9%. That would give me 284 there, or 285 if you round them up. But the figure that we need to input in our free cash flows to equity or the NPV calculations would just to be the incremental cash flows, which means the changes. If you're not happy with that word, incremental. That's why I will always use the left-hand side minus the right-hand side technique. So for example, in year 1, the left-hand side seems to be 0, but it's not. Because as I said before, we've got the net current asset of 270 and we've got cash of 50, which means in year 0 we've got 220. So 220 minus 239.8, that will be minus 20 or 19.8 there. In year 2, we take the left-hand side and to subtract the right-hand side. That would give me minus 21.58. In year 3, we take the left-hand side and to subtract the right-hand side. That would give me 23.52 there. So after we've done with that, we'll then copy the working capital note in our calculation. So for example, I've taken this, press enter, and then drag it here. And that's all I can do. No more than that. Now, anything else? Well, the answer is yes, because we will also need to see the investments that we will need to make, okay, in the project. Don't forget about that. Because as we can see, we've got the additions. So, if you can recall the additions, you just calculated here. That would be standing for the investments that you need. And that's why we can also say the additions or non-current asset investment will take the minus figure, the additions, press enter and drag it here. Do you need to explain to the examiner? For example, putting some words next to that? No. Because the examiner marking your script will certainly be focusing on your figures. Right, okay. After we're done with that, we can calculate something called the free cash flow to equity by summing all these down. So for example, we got the profit, blah, 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 and that'll be 114.5 and drag it here. Job done. Examiner will first need to see whether or not the free cash flow to equity is correct. If you've done with the correct calculations that are highlighted in red here, you can get the full marks without the examiner looking backwards about your workings at all. Because if you get these figures right, there's no point that you will get something wrong in your calculation. But if you can't get this right, because it's 9 out of 10, the students would get these wrong. Therefore, that the examiner would follow through your calculation step by step from the very first beginning and just check whether or not you put the numbers right or put that in the correct place, which means the correct year. If something is wrong at the very first start, then you can't get marks on that working. But later on, basing on your wrong calculation to do the subsequent workings, you can still get marks there. And of course, the examiner will put the OFR next to that, label next to that, okay, to give you subsequent marks, because all the errors can only be punished once rather than twice. Right then, so that's the free cash flow to equity. But how about in the part B? Estimates the value of equity basing on the expected free cash flows to equity and the terminal value basing on the sustainable growth rate 3% per year thereafter. Well, we need to see that in the subsequent note here that we are told the growth rate of 3% and the target return from the shareholder would just to be 10% as the discount rate there. Okay? So, if that's the case, that I tell the examining team that this is the part B now. For example, we've got years 1, 2 and 3. Clearly, I will need to, basing on the free cash flow to equity in the part A of our calculation. If you didn't calculate anything, just to assume a figure is absolutely fine there. It will not affect your total marks in part B. But I've done with the calculation in part A, so that's why copy that there and drag it here. But here, we're also told that a sustainable growth rate thereafter, which means from year 4 to the future. Now, the ways that we calculate this each and every time will be rather straightforward. Firstly, we like to take the cash flows from year 3 and then timing by 1 plus the growth rate here will be 3% there at the very first start. But don't forget that this is the perpetuity. You will need to divide into the required return from the shareholder, which means 10% there, and just subtract the growth rate. And then enter that, that will give me 2547.7. Okay. So, the next thing will be to discount at 10% because the free cash flow to equity only reflects the cash flow attributable to shareholders only. So that's why we use 10% there, will be the required return from the shareholders. In year 1, we take 1 over 1 plus 10% for the power of 1. Okay, put a bracket. Just drag it here. Remember, from year 4 to the future, I always use the year 3 discount factor, so I can discount from the start of year 4, which means the end of year 3, back to now, because we need to calculate the present value now. So calculate that present value by taking free cash flows to equity, timing by the discount factor. Press enter, drag it here. So I can calculate the total present value by summing all of these. That will give me $22,66,000. Okay, and that considering the sustainable growth rate of 3%. So that's a major working that you need to work this out. All right. Now, final requirements. Final requirements. Advise the directors on the assumptions and uncertainties in your valuation. Well, I will say that, firstly, looking back to the note, Now, taking keywords out, so for example, directors will not take a dividend for the next 3 years, but we expect the cash flows will grow by 3% each and every year. Now, we'll say that, firstly, I'll write it in incomplete sentence, but don't do that. You need to write in full sentences. So, for example, I would say that the growth rate is 3%, may subject to change. You can give an example on that. So, for example, how about the level of competition in this market? How about the technology changes related to this industry? So that's why not only you can get 1 technical mark, but here, according to the marking scheme, you can also get 1 skepticism mark by commenting on the changes. Secondly, we're told about the target return on the equity will be 10%. But that represents the opportunity costs of their invested fund. So this means that they've invested something. It seems to me that it's more of a well-diversified portfolio that they are holding. So therefore, I can say the discount rate of 10% that to a certain extent may be understated, because maybe basing on well-diversified portfolio, it has been averaged, so it may be averaged, which means the actual required return could be higher. Perhaps it's more risky for this one, because the average 10% of the required return may not be for this particular project, for example. All right. Well, you can get 1 technical mark here. So how about the valuation? If you can see that in your calculation it's 3 years and 4 years to perpetuity. Well, the number of years of 3 years may subject to change each one. So for example, you can talk about the competition for 3% of a growth rate and technological advancement for the 3 year of a project life cycle there. You can get 1 technical mark here, because you're talking about something to change, and according to the marking scheme for this question, that you can also get 1 acumen mark here. Now, not just for that, but also that you can talk about the growth rate for your sales revenue, variable costs, and even fixed costs. These may not be accurate because all of them are estimates. So for example, will not still be inflation changes in the market? You can get 1 technical mark here. Now, finally, because we're told about the value of equity based on the expected free cash flow. As I said before, we'll also need to consider the risk attaching to it. So that's why you can use sensitivity analysis. Now, don't stop that, to identify the key variable. Okay, it's the maximums that are key variables. So for example, it's the selling price and the cost element could change. Okay, by what extent that they can change before the NPV of a project or the value will be negative. Of course, you can also touch on discounted payback and also the payback period. It's entirely up to you though. So not only you can get one technical mark, but here, according to the marking scheme, you can also get one analysis and evaluation mark as the professional mark here, the A&E mark here. Alright, so the maximum marks that you can get, for example, for this question, that you will get 5 and also 3 of the professional marks for the single Part C requirement here. Make sure that you're ready. But not just for that, also for the Part B, that you're also given 1 analysis and evaluation mark, okay, for the correct calculation, even for the Part A. So that's where the 5 marks, professional marks, are coming from. Okay? Hopefully that you're happy, okay, with the free cash flow methodology. Now, before I move any further to the next part of the revision, focusing on the example area number 2, I would like to stop the tape and to take a break. And I look forward to seeing you soon in the example area number 2 then. Bye-bye.
APC, accounting for your future.